Hello, welcome to this interesting short video course on how to almost guarantee your winning in the US market as an investor. So here I'm going to teach you how I trade the US, how I invest in the US market because there is a clear difference between trading and investing. When you trade the US market, you're looking at buying stocks at the lower end of the market, hoping that when it goes up, you will sell. So that means you're actually taking advantage of market volatility. Now, the advantage of that is that you tend to get quick returns, and disadvantage is that you might actually lose your money. So the only way you can sustain your portfolio is to make sure that you win more and lose less. That is trading. But in investing, you can actually guarantee your success in the market year on year without losing any money. Is it possible? Yes. That is exactly what I want to share with you. Now, before I go on, I want to probably show you some interesting data to prove to you that you can actually make money in the US market as an investor without losing. Yeah, we have the likes of Warren Buffett, Peter Lynch, and William O'Neill, and all that. Now, these guys have actually amassed billions of dollars from the US market as investor. Why? Because they held on to certain stocks for a long time. They were not traders. They invested in the market. Now, when you invest in the market, you increase your chance of making the most money. All you just need to do is to exercise patience. Now, before I delve in, let me quickly show you some interesting data about the US market. Now look at this. This is the these are historical data of SPS index. SPS index is an index that tracks the top 500 companies in the US market. That's top 500 by market capitalization. You have the likes of Apple, Google, Microsoft, Tesla, Amazon, Salesforce, and all that. These are big cap stocks. So top 500 by market capitalization. That's what SPS does. So this interesting data here tells us we can see the opening price of SPS for the year and then the closing price and also the percentage change. So we'll be interested in the year and the percentage change. So this data dates back to almost 90 years. That's like 1928. Yes, you can see here 1928. So look at this. You can see that in 1928, the market closed by 37.8%, 1929, 11.9%, and all that. So the green there represents a bullish close. That means the market closed higher, while the red tends to indicate that the market closed lower. So what am I going to do now? Let's quickly look at the number of times the market closed lower and then number of times the market closed higher. So you see that the market closed. So I'm going to be counting the green: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47, 48, 49, 50, 51, 52, 53, 54, 55, 56, 57, 58, 59, 60, 61. That means the market closed higher 61 years. So out of the 90 something years, that's between 2021 to 1928. So 2021 to 1928. So we have that's like sorry, that's like 93 years. So 93 minus 61. So you can see that the market closed higher 61 times. That's 61 years out of 93 years, and then went down by 32 times. That means in the last 93 years, the market has been up by 61 years and then 32 years. So if we do 61 divided by 93, so it means the market went up 65%. So 65% of 93 years, we have recorded more gain. And then the rest, which is like a 35%, we have recorded losses. So what does that tell us? So it tells us that the market is clearly in an uptrend. And let's quickly look at that again. So SPS, this is the chart of SPS And I'm going to look at this from the monthly charts. So even though it's not going to give me the price in the last 93 years, but at least the monthly chart dates back to 2014. So 2014 up to 2021. So you can see how the market had been on a solid uptrend. You can see right here, very up long term. So that is an impressive numbers. That tells us that the stock market had been in a strong bullish run right from 1928. So let's look at another interesting data again. Now you will see again that in the last 15 years, the market it's up has recorded 10.9% gain. The last 10 years, 16.86%. In the last 5 years, 17.87%. In the last 3 years, 18.22%. In the last 1 year, 32.55%. 6 months, 18.24, 7.7, and up to a month. So, but I'm interested in 15, 10, 5, 3, 1. That's also another data. Then let's look at 2014. The market went up by 13.69, 2015 1.38, 2016 11.96, 2017 21.83, 2018 went down by 4.38, 2019 31.49, and 2020 18.4, year to date 20.3. This is from 2014. From 2014, you can see here. So if you had held if you have held SPS from 2014 up to date, you should be up. So interestingly, people are still losing money despite these good numbers. Despite this positive return that the market has recorded, people are still losing money. So the question is, why are people still losing money in the stock market, even when the index itself is recording positive growth year on year? So for someone who is an amateur investor, you could even buy into an ETF. If you buy S&P 500 ETF without doing anything, this is the return you should have made. So if that's someone that is even starting out in the stock market, you don't even know anything about stock, or let's say a newborn baby, you decided to even invest in the stock market for a newborn baby, and you decide, and rather than buying just random stocks, you bought SPS 500 ETF. So you can see in the last 15 years, so meaning that by the time the baby clocks 15 years, his portfolio would have been up by 10.9%. If it's a baby that's 5, 10 years old, it would have made 16%. If it's 5 years old, 17. If it's 3 years old, even in the last 1 year, a baby that you that was given birth to last year and then just clocked 1 year, maybe like 1 year birthday, his portfolio would have been up by 32%. So why you who even understands the concept of stock trading, why are you not actually making money year on year? So that means there is something you're not doing right. There is something you are not doing right, because by default, you should be making money in the stock market. Why? Because the stock always goes up. Look at this. So when people talk about stock market crash, stop going down, the truth is that the stock market will not go down. The stock market will keep going up. So each time you see the market go down, you can see that it tends to bounce back. So at several times, we've seen the market crash, maybe because of a global crisis, COVID-19, dot-com bubble. There will be several reasons why the market will dip, but eventually it would bounce. So why is the stock market always going up? That's the question. That's the question we need to ask ourselves. Why is the stock market always going up? From this data that I share with you, you can see from 2014 to 2021 is almost like 18 years. So why is the market always going up in the last 17 years? It's simple. I'm going to share three key reasons the market will keep going up and will keep going up and will keep going up. First is, let's look at the company that make up the stock market itself, or the S&P, or whatever it is. Now, these are companies that sell different products. Some of them they sell products, some of them are service based, some of them are manufacturing and all that. And each of them they tend to meet up to demand, and we buy their products probably to support our livelihood or to support our standard of living. Now, one is population growth. As population keeps growing, the demand for goods and services will also increase. And each of these companies, they sell more of their products as we increase in number. It's as simple as that. They sell more of their products as we increase in number. Now, the population of the world 5, 10 years back. It's not the same thing as what it is now, and it will not be the same as in the next 5 to 10 years. So that tells you that as we increase in number, the demand for essential commodity, demand for what we sell, will keep going up. So that explains the reason companies will keep selling more of what they are selling and will also keep making money as they have always been doing. The second reason is inflation. Now, when population increases, the demand for products and services also follows suit. And when there is more demand chasing few goods, what happens? Prices will go up. Companies will start increasing their prices. Look, let's even look at Nigeria as an instance. The scarcity of food has created what? Inflation. Because what? Number of people that wants to consume, more people that needs them actually more than the quantity that is available. So it's natural for prices to go up. So if you look at it from the global perspective, the population of the world is growing and people will always need to consume products. People will always need services. Look at mobile phones. People are always buying phone. As more people are born into this world, they will get to a certain stage that then they will need phone to probably make communication easy. And more people are being more people are being given birth to. The demand for mobile phone will keep increasing, and so also every product that we consume. So population growth is number one, inflation is number two, and number three, which is very important, is the US Fed. That's like a central bank. These guys will never allow any business to go down. So when you see the market dipping like this, take advantage of it. Why? The Fed is designed to stimulate an economy. That's what they do. When an event occurs that tends to bring businesses down, what happens? The Fed will step in. And when they step in, they're going to be printing more money. The money they print, they use it to probably help businesses to survive, buy debts, stimulate businesses, give soft loans, boost the economy, provide incentives. They just want business activities to go on because when business activities are actually going on, when businesses are booming, that's where they will pay tax. So if businesses are not booming, if economic activity is on hold, who is going to pay tax? Nobody. So they wouldn't want these guys to go down. So and in the process of booming, they actually stimulated the economy, and in turn, employment comes in and the stock market will keep going up. It's as simple as that. The stock market is not a single person, it's made up of companies. And these guys are involved in production of different products, rendering of different services and all that. So the Fed will not allow them to go down, but they provide employment. When there's high unemployment, it's important to the government. So the Fed is the single most important reason the US market will keep going up. So you can see here. So that explains the data that you see here and how that the market had always been in an uptrend for almost 65% of the time. Now, what does that percentage tells you? It tells you that when you buy a stock and hold for the next 12 months, your chance of making money is almost like 65%. So, and that's if you hold on to the SPS. That's what I mean. I'm referring to the SPS. So your chance of making money if you buy SPS ETF is 65%. So why are people still losing money in the market? Why are people not making money in the market? Why are people not taking advantage of the billions of dollars that is circulating the stock market? So that they say, I don't know what stocks to buy. I don't know how to invest. If you don't know what stocks to buy, go and buy SPS ETF 500. SPS 500 ETF. We have the Vanguard is there. Buy, keep. If you buy, keep, your chance of making money at the end of the year is 65%. And I'll show you data to prove that. And you can see from here, the market had always been in a bullish trend. In the last 1, 2, 3, 4, 5, 6, 7, the last 7 years, the market had been up 6 times and it's only down once. Meaning that if you had bought into SPS 500 in 2014 up to 2020, you probably should have made more money without doing anything. So for an individual investor now who is looking for stocks to buy, there is a secret to now increase your chance. Move from 65% to 98%. So meaning that you almost guaranteed your success in the market by following this secret strategy, excuse me, I'm about to share with you. This secret strategy will almost guarantee that year on year, you don't lose money in the stock market again. Meaning that I'm going to show you how to pick the best of the best. Because in the midst of this uptrend, that you see here, there are companies that are delivering the best return. There are companies that are delivering massive return. But now, SPS is made up of 500 companies. And it's not all the 500 that are actually going up. Some are going down while others are going up. So what does that mean? It tells you that if some are going down and others are going up, but the overall index is up by this percentage, then the ones that are going up should be delivering far more return than this. So meaning that I'm going to move the probability of success from 65% to 98%. So that means every year you actually guaranteed to make money in the stock market. Now let me share some stocks that I've actually picked and how that this strategy always work. Now there are three stocks that I'm going to be mentioning. Now these three stocks, they actually went through my criteria. They are part of the stocks that help to deliver this return, and they are even making more. And I've held this and I've been able to buy into these stocks in the last 1 year, and I'm still riding them going forward because their financials are perfect, they are beating the return, and interestingly, from my stock valuation, they are still undervalued. Now, one of the important secrets of this particular strategy is that you don't just jump into any stock, but you move into stocks that people are buying, stocks that is outperforming or beating the SPS, meaning that if someone is buying the SPS and SPS is up by 18%, you're almost guaranteed that you're going to make more than the SPS, and also see the value, the fair value of this stock to almost guarantee that you will make money in the stock market. One of the stocks that I'm buying is what I call CG. CG. So CG is Caroline Group. So let's look at the um, the trend of CG. You can see right here, this CG in 2021 at the beginning of the year, CG was selling for 31. So right now, CG is almost up to 48%. So 48 minus 31, that's like 17. 17 divided by 31, that was like 54%. CG is up by 54%. Now, can you see the strong uptrend? You can see the momentum. Now, this kind of stock, what I do is that anytime I buy this stock, I always buy them when they dip because they mostly find their support at any of these moving averages. These are things I'm going to be showing you in my premium webinar. My premium webinar, I'm going to be showing you how to pick this kind of companies, how to pick the best companies that will almost guarantee your success in the stock market year on year. So rather than keeping your money in the bank, these stocks are going to deliver far more return in USD. So look at CG stock. You can see that anytime the stock trades close to its moving average, it tends to bounce back. You can see right here, bounce back, bounce back, bounce back. You can see overall the stock is up. You can see this is very good. These are interesting stocks, and I've already keyed in into these stocks. Now, why did I pick CG? There are so many things that are going to be put into play. The performance of CG had actually beaten SPS. That's very clear. Now, if we go back to our charts, so let's look at CG on charts. So this is CG, 48.94%. So let's look at the performance of CG. So financials. Okay, so this is the financials of CG. You can see from 2017, 2.3, 2018, 1.8, 2019, 2.7, 2020, 1.8, and trailing 12 month 4.9. So we're looking at a company that is generating revenue consistently. So and also should be have consistent growth in their revenue. So we can see right here. And then let's look at the profit again. 238 dipped 92.9, 345, 384, and 2.6 billion. This is it. So let's look at the cash flow of CG. Sorry, please. I'm trying to launch the cash flow statement of CG. Okay, this is the cash flow of CG. So you can see right here. So the company trailing 12-month cash flow is 503. So now the importance of looking at the cash flow is that a company can manipulate its sales, a company can manipulate its profit, but they can't manipulate cash. So when the company is saying, "Ah, we are growing our sales, we are growing in profit," always look at how much is available as cash, because that's very important. That's what the company needs to finance operations and also to be able to make up its working capital needs. So this is operating cash flow positive. Now, so now we want to look at the fair value of CG. What is the fair value of CG? CG is currently selling for 48.94. You can see right here, 48.94. So is it right for me to pay 48.94 on this stock? Because you need to also look at that price. It's important. You're holding the stock for a long time. Make sure you are paying a bargain price for that company stock. So there are a few metrics that I'm going to be putting together to value this company. So I'll quickly launch my Excel sheet. So let's look at the value of fair value of CG. So now I'm going to plug in my free cash flow, which is 447,900. That's me. This is million. 447,900,000. So 447,900,000. So sorry, 447,900. So this is my Excel sheet. I use this Excel sheet to be able to calculate the fair value of a stock. I don't have to stress my head around punching calculators and all that. Once I put in the key in the numbers, that's all. And you can actually find all this data on Yahoo Finance. So no stress. So Yahoo Finance. So I will go to analysis. Let's look at the projected growth. What are analysts projecting this company? So we're going to look at the growth in the next 5 years. So what are analysts projecting on this particular stock? So analysts are projecting the next 5 years. You can see right here, they project this company to grow by 21.96%. So I like to be very modest. So sometimes I'm going to come down to 20% and 15%. So here we plug in 20%. Now, this 20% will not be a constant growth. So it's assumed that in 6 to 10 years, the company's growth is going to reduce. So that's why we had to have it up to 10. So it means that whatever growth number we are assigning for the first 5 years, we're going to assume that the company will actually grow less from 6 to 10 years. So it's just an assumption, and you have to be modest so that we don't exaggerate. So that's why in 6 to 10 years, we assume that the company growth will dip to 10%. So first 5 years, 20%, 6 to 10 years, that's going to be 10%. So terminal growth here is the growth in GDP rates and all. And no company can grow faster than the economy or sector that it's in. So that's the growth at the end of the 10th year. So after 10 years, well, expecting the company's growth to also dip further to 10%. So discount rate, it's you can see here, our discount rate is 7.1%. So what's the share outstanding on CG? So let's quickly go to Yahoo Finance again. You click on statistics. So you can see that share outstanding on CG is 357.76 million. So 357.76 million. 357.76 million. That's the share outstanding. Then what's the debt level of CG? What's the debt level of CG? You can see that I already have all the data on Yahoo Finance. I don't have to wrap my head around anything. So the debt is 8.21 billion. So I'll come to my sheet, 821 billion. And then what is the total cash? Total cash is 1.85 billion. So I'll come here. The total cash is 1.85 billion. That's all. This is what I need to plug into my Excel sheet, and then my fair value is already calculated. So what's the current price of CG? CG is 48.94. So I'll come back here, come down here, 48.94. Now you can see that based on all that I've plugged in, this is a projected cash flow. You can see the first 5 years at 20%, the next 5 years at 10%. So this is the future cash flow of the company projections. And then we have all the figures right here. So from what I just entered, the estimated fair value of CG is what? 87.94. That means the company should be trading at 87.90, sorry, 7.90%. Now, there's what we call margin of safety, just to allow for errors in case there might be room for, there might be error, because this is just an estimate. So we have to provide for that error. So margin of safety here we ensure that we don't pay past a certain amount of money for the company share. So the margin of safety for me is 30%. That means I don't want to pay more than 30% of less the company's fair value. So that means 30% below the company fair value. So if the company fair value is 87, because it's an estimate, I don't want to pay more than 30% below its fair value. So 30% below this value is 61%. So even at 61.53, the company is still considered undervalued because the market price is 48.94. So if the market price is 48.94 and margin of safety is 61 and my estimated fair value is 84, that tells me that this is a very good company to buy into. So if I go back to my charts and I look at CG, you can see how the company has been going up strongly. So any dip, as long as it's still below my margin of safety of 61, I'm going to jump into the company stock and then keep holding on to the company stock. So that's how to pick a very good company to buy into. Now, there is a process to analyzing this company. There's a process to knowing what stocks to buy. That is exactly what I'm going to show you in my premium investment course. I'm going to show you how to screen 8,000 stocks to know the actual ones that are actually delivering more return. Because if the S&P 500 is delivering positive return year on year, why are we losing money in the stock market? So there is a way to now check for stocks that are actually outperforming the S&P 500. So we're looking at stocks that are sure bet for us, stocks that if we hold them in the next 1, 2, 3, or 4 years, we are so certain that this stock is going to deliver return. So that's exactly the kind of companies we want to buy into. And when you go to Yahoo Finance, you can see different updates, different news. You can see here 19 hours ago, you can see here top financial stocks for September 2021. So you can see right here, even on Instopedia, it's being listed as one of the top financial stocks to hold for 2021. So these are kind of stocks we want to buy into, stocks that are delivering massive returns, stocks that people are buying into and that have a predictable trend. You can see between January up to now, the trend of this stock is so predictable that anytime it dips back to 20 or 50 days moving average, it tends to bounce back. You can see right here. And there are so many things to watch out for. The first thing you can always look out for is trend. So even though I've done my screening and I want to buy into these stocks, the first thing I look at is trends. I need to make sure that it's a momentum stock. How do you know that the stock is a momentum stock? By comparing the moving averages. This is 20 days, this is 50, this is 100, this is 150. Now, a momentum stock we have it 20 days above its 50, it's 50 days above its 100, it's 100 above its 150 moving average. That's how a momentum stock work. Now, this momentum stock must also be showing massive uptrend going forward. But that's not all. That is not all. There's so many other metrics to watch out for because the idea is that you want to look for stocks that are beating the S&P 500, stocks that you know have predictable uptrend. So if this CG stock dips a little bit below its price or this back to the moving average, I'll quickly jump into buy because I know it's still fairly valued and is fully undervalued and far below its price. You can see the fair value is what? 87.9 based on all that I've keyed in, and the stock is selling for 48.9, and the margin of safety is 61, and right now it's 44% undervalued. So by the time the price gets to 87, that's where I will start selling a bit of my stock to take profit and then look for another undervalued stock. In this kind of stock, I buy them big. I go big in these companies because I'm looking for companies that will give me guaranteed return. So the money that's going to keep in my bank and where I'm not going to earn anything, I keep them in this long-term stock that are guaranteed to give me good return after a year. So that's exactly what we're doing because SP 500 has shown to give us positive return year on year. So we can't afford to settle for less. Now let me take you to another interesting stocks that I actually own in my portfolio. This is MIDD. So let's look at these stocks. You can see again, this is another interesting stocks. That's Midley Corporation. You can see how the 20 days moving average is above the 50 above 150, 100 above. You can see with each of them lining up, showing a very strong uptrend. So let's look at the stocks on charts. Sorry, let's look at the key metrics of this company. This Midley Corporation. You can see the Midley Corporation, also known as Middle by, is an American publicly traded commercial and residential cooking and industrial process equipment based in Elgin. The company manufactures commercial cooking equipment. So this is a company that manufactures commercial cooking equipment. So I'm sure they supply equipment to bakeries, food processing companies, and all that. So I'm sure they're also going to benefit from the demand for food and then pastries. So let's look at more information on this company's stock. Okay, so while it's loading, I want to quickly show you something. So, sorry, please, I have to just close it. Let me reserve it for the premium students, people that actually subscribe for my course. Okay, this is it. This is Middle by Corporation, and you're going to see different updates Middleby Corporation. Here is why it is worth investing and all that. And Middleby Q2 in its beat estimates. So these are stocks I'm investing in. So let's quickly look at the financials of the company and also the fair value. How much do you think the company is worth? Is the company overvalued or is it undervalued? So let's deep. Okay, so this is the revenue. 2.3, 2017, 2.7, 2.9, 2.5, and 2.930. So consistent growth in revenue. Now profits 298, 317, 352, 207. You can see because of COVID and then 322. So the company is on track to beat its previous year earning. Remember, I said something that revenue and profit are not enough. We also need to pay attention to cash flow. Is the company generating enough cash? Is it cash flow positive? You can see right here, yes, operating cash flow is positive. And then you can see the free cash flow. Now, another interesting thing you might also want to look at is debt. You understand? You might also want to look at the company's debt. Is the company debt level or is it too exposed to debt? So what I always watch out for is I look at the net debt to earning before interest and tax. So what is net debt? You take out the total debt minus your cash. So you can see net debt is 1.46. So net debt to earnings before interest and tax must not be more than 3. So that's also very important. Net debt to earnings before interest and tax must not be more than 3. That tells you that the company generating enough cash to cover its debts. So let's quickly look at that too. So you can see here So you can see here. So net debt to this must not be more than 3. So you can see here. So 1.4 divided by this not more than 3. So you can it's less than 3. So that's also good. Now another thing again you can also look at is interest coverage ratio too to be sure that the company can also pay out its debt from its earnings from operation. So that's like earnings before interest and tax to interest expenses. So it's more. You can see which means it's operating its earnings before interest and tax can actually cover or pay up its interest expenses. So the company is not too exposed to debt. So let's look at the valuation. What's the value of middle buy? What's the fair value of middle buy? And is 183 a fair amount we can pay? We should pay for that stock. So let's quickly look at our analysis. 493,906,000. That's the estimated cash flow. 493. Let's confirm that again. 493. This cash flow 493,906. 493,906. 123. So what's the projected growth rate? What are analysts projecting Dubai to grow by in the next 5 years? So let's look at the analysis. So in the next 5 years, it should go up by 27%. So, but like I said, I like to be very modest, 20%. So we still maintain our 20%, and then 6 to 10 years, the growth should be able to aim by half to 10%, and then last year 4%. So let's then look at other key figures that I want to key in. Go to statistics. So well, let's look at the cash level. So the company has 395.56 million. 395.56 million as cash. 395.56 million as cash. And what is the debt level of the company? Debt is 1.88 billion. So debt level 1.88 billion. And what is the share outstanding? What's the share outstanding? The share outstanding is 55.63 million. 55.63 million is the share outstanding. And what is the current price of the stock? 183.11. So quickly come here and say 183.11. Now, can you see right here? Now, for my Excel sheet, my fair value for this company, my fair value for this company is $722 per share. That's the fair value of this company, $722 per share. Now, if I want to be modest again, I can say let's bring this down to 15. Let's look at a growth rate of 15. So even if the company is growing by 15% and growing its cash flow by 15%, um, the fair value is still around 525%. And what's the current price? 183. Now, the margin of safety is 368, meaning that I shouldn't pay more than 368% for the company stock. So the margin of safety is still far above the price of the company stock. So this is a company that is grossly undervalued. You can see right here, grossly undervalued. Now, this company supplies equipment, kitchen equipment to different companies. So you can see right here again, you see 3 hours ago, US business spending likely to remain strong. 5 top picks, and the company is even there. This is just 3 hours ago. And then you can see here is why it's worth investing in this company. So let's look at some of the reasons 6 days ago. You can see how this company beats its sales and earnings. You can see here reflects gains from solid product demand and improving market condition. So let's look at this article. Here's why it's worth investing in this company. You can see some of the reasons. Strong order growth. You can see middle buy is expected to benefit from solid growth in order across all the segments, robust backlog in the quarters ahead. That means the company has a backlog of 944.2 million, indicating an increase. So backlog of orders are like demand for the product. The demand for the product the company is yet to even meet up to, of worth of 944 million, which is like 34% increase. That's like a sign of an improving demand. You can see acquisition benefit. The company intends to solidify its product portfolio and leverage this through addition of assets. The acquisition of Novi is expected to strengthen its product offering in the residential beauty cooking market. That means the company just acquired another. You can see healthy liquidity position and estimate in the past 30 days, analysts have been increasingly becoming bullish on the company as evident from positive earnings. So a lot of things are adding up to the company's valuation. So which means that we should see more upside in the coming weeks, months, or even years. And from my Excel sheet, I have a fair value of what? 525%. Now, if I also want to be modest again, let's even come down to 10%. Assuming the company is growing the cash flow by 10%, you can see it's still grossly undervalued at what? 183. You can see 377 USD, which is far higher than 183. So that tells you that this is a very solid company to buy into. So you can see right here how the company is recording massive growth. So every time the company dip, that should be an opportunity to add up to your portfolio. You can see here how the company has been growing massively. At the beginning of the year, the company started at 127. Right now, it's selling for 183. So 183 minus 127, that's like 56. So 56 divided by 187, 44. So the company is already up by 44% year to date. That means if you hold the company stock, despite the up and down movement, and decide to run it for the next 1 year, I'm so certain that this company share will go up. So that's how to buy stocks that would beat the S&P 500. So you need to be able to learn this process, and it's not difficult. It's a simple step process. The first one I'm going to show you is how to screen for stocks like this. It's very important. How do you check for stocks like this, stocks that are going to outperform S&P 500? That's the first one. Second one is how do you check for trend? How do you know that the company is in a solid uptrend? How do you know that the company is in a solid uptrend? That's number two. Number three, you're going to, just like I showed you, we're going to do financial analysis of each of these stock to pick the one that is best. And it doesn't just end there. How do you then know the fair value of this company? How do you know the ones that is actually cheap compared to the market price? So you can quickly buy them at a cheaper rate. It's like promo. It's like going to the supermarket and then you're seeing 48% discount, just like this now, 52% discount, meaning that you can buy now and enjoy the value of what? 377 USD. And if I go back to the normal fair value of 20%, which analysts have put on this stock, we should look at this stock that should be selling for $722. And at the price is what? 183. That means the company is undervalued by 75%. 75% by looking at the cash flow, the terminal value, the growth rate, and every other information that we need to estimate the fair value of this company. You can see in the space of 1-2 minutes, I've been able to pick or do my analysis and then to know. So the idea is to have a collection of undervalued momentum stock or momentum stocks that are still undervalued. Why do I call them momentum? They are recording strong, impressive growth, but they are still considered undervalued relative to what? Their share price. That's the kind of company you should buy into. That's how to almost guarantee your success in the stock market. The last but not the least, let's look at another stock. We call it YTI. It's called Yeti Holding. So I've given you three solid stocks you should build, you should add to your portfolio. You can see how this company is also maintaining a solid run. So every dip to the moving average, there should be an opportunity to add up to your portfolio because the company had been going up steadily. So you can see in 2021, the company started from 67 and right now is selling for 101 USD. So 101 divided by 67 minus 67, that's like 30. It has added $34. So $34 divided, so it's up by 50%. 50% in the past 8 months. So that is another solid company. So let's look at the fundamentals of this company, Yeti stock. Yeti stock. So let's go to Yahoo Finance to check for the fundamentals of this company. Interestingly, when you do a search for this company, you have less than 10, 5. You can't find like 100 of this company. There are just few. And one good thing about the screening that I'm going to show you is that it tells you when the company is down. It only shows you companies that are down. So which means they are ripe for entry. So it's not like you're buying them, you're screening and then you have to wait for additional days before you buy. It shows you companies that are down. So these are momentum stocks that are down and are considered undervalued. So this is Yeti, and you can see some other news about Yeti. You can see here, Yeti Holding looks to prolong its impressive return. This is 2 days ago. Why Yeti could be an impressive growth stock. So let's look at the financials of this company. So you can see 639, 778, 913, 1.something, 1.2. You can see steady growth in revenue. Let's look at the profits. 115, 57, 50, 155. So you can see steady growth in profit too. Now, revenue and profit are not enough to look at the performance of the company. Pay attention to cash flow because you want to be sure that the company can generate enough cash to cover it. So you can see that the company is also cash flow positive at this point. And what is the operating cash flow? Free cash flow is 244.44. So the company is cash flow positive. You can see right here. So cash flow positive. So let's calculate the fair value of this company. So how do you estimate the fair value of this company? You can either pick notes, you can either pick the operating cash flow of this company or you can go to it. So some pick operating cash flow, some pick free cash flow. So this tells you how much was generated in the company, then which this tells you how much was generated after accounting for capital expenditure or what after accounting for certain expenses. So that is what this free cash flow tells you. So for me to be modest sometimes, I always go with the free cash flow, which is a bit lower because I want my fair value to be a bit modest. So let's look at it 274,444,000. So we come here 274,444,000. So what's the projected growth of this company? What are analysts saying? And what percentage should we expect this company to grow? So remember, this is just an estimate. So in the next 5 years, 24%. That's 24%. And remember, let's stick with our 20% estimate for us to be modest. So we don't want to over exaggerate our fair value and then statistics. So what's the share outstanding? Is 87.47 million. So share outstanding is 87.47 million. 7.47 million. And what is the debt level of this company? The debt level of this company. The debt level is 194.26 million. 194.26 million. That's the debt level. And what's the total cash? Total cash is 233.77 million. 233.77 million. 233.77. So we have imputed all that we need. We've entered the cash flow, we've entered our debt level, share outstanding. So what is the current price of Yeti? 101.78. So we come here, see 101.78. So I hope we entered the right figure. Sorry, 20. Let me look at it again. Share outstanding is share outstanding is 87.47 million. 7.7 million. What's the debt level? 194.26 million. 194.26 million. And what's the cash? 233.77 million. 233.77 million. What's the initial cash flow? Yes, let's go with our 24. So, if we have done all our, oh, sorry, please, I think I saw it, 274, 444. Sorry, I've seen it. 274, 444. Yes, this is where the error is coming from. So sorry about that, please. Okay, yes. So the fair value of this company is 265. You can see right here. So the fair value of this stock is 265.28. So this stock should be trading for $265. Now, margin of safety is 185. Margin of safety. So for someone that doesn't understand what margin of safety is, so let me quickly show you something. Okay, let me show you something. So you can see margin of safety is different between the amount of expected profitability and break-even points. Hmm? See, margin of safety is a principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. You can see right here. That's what margin of safety is. So you can see here is the principle of investing in which an investor only purchases stocks when their market price is significantly below it. So what does that mean? The margin of safety tells you the amount you shouldn't pay more than. So the margin of safety on this stock is 185 and the current market price is this. So it tells you that bearing all the calculations you've done, let's assume you made an error. Let's go down by 30% below the value, which is 185. Compare this with the market price, it's still undervalued. It helps you to remove errors, take out errors, and also ensure that you don't pay above a certain amount. So you can see that this stock is grossly undervalued by what? 62%. You can see these three stocks I've analyzed, they are grossly undervalued based on their cash flow, debt level, discounts, and every other things you need to impute. So that tells you that the company stock is significantly undervalued. So let's go back to Yeti as a stock, YETI holding. YETI holding. So you will see, so these are the type of stocks that I buy that guarantees my profit in the US market year on year. And the kind of profit I generate in this US market can pay my bills. That's how an investor thinks. You don't buy into a stock and hope that the next 2 or 3. But yes, it's good for you to trade, but make sure you have that long-term portfolio that gives you that guaranteed success, that guaranteed return that always beats the markets. So if S&P 500 is going up steadily, even for an amateur investor who is buying ETF, and at the end of the day, he's able to generate money, how much more you that understands the stock market better. So you can't afford to be in this market and you are still fumbling, you are reporting loss on your portfolio at the end of the year. There should be that portfolio that will give you guaranteed return. That's why I said that I'm going to show you a strategy that would move your probability of success from 65%, because the market had been up by 65% in the last 3 years. So I'm going to show you how to move from 65% to 90%. You can see here the market always goes up. So all you need to do is to be able to key in at the bottom. So what I'm going to teach you in that strategy is that I'm going to teach you how to be able to pick these outperforming stocks, how this undervalued growth stock, and then how to also buy them when they are retracing from pullback. That means you're going to buy them on pullback. You're going to buy them when they are down, hoping that they are going to continue their ride going forward. So that's exactly what I'm going to be teaching you in my premium investing course. So I've put up this video to show you and prove to you that you can actually buy into solid company, you can build a profitable long-term portfolio in the US market that will guarantee your success by 98% and not lose money. If S&P 500 itself is doing well year on year in the last 10 years, 15 years, 20 years, 30 years, 5 years, 1 year, you should be earning more money than the S&P 500 or than someone who is investing in the ETF. So I'm inviting you to join my next webinar. You can see details below. Join my next webinar and come and see how to be able to pick the stocks that would guarantee your success in the market. Some of the things I'm going to be teaching you are: number one, how to screen 8,000 companies and pick the best of the best. And I'm also going to be recommending additional stocks in this webinar, and then how to do your analysis. And the ultimate part, the bonus I'm going to do is that I'm going to give you my Excel sheet for free. So the big bonus you're going to get is that you're going to get access to my Excel sheet. I'm going to send it to your email so that going forward you won't be struggling with fair value calculations again. All you need to do is to input the necessary figures, and boom, you'll have your fair value calculated. Because it's not proper for you to go into a stock or buy a stock when you don't know whether you are overpaying for the stock or underpaying. So fair value calculation tells you whether you are paying less than the value of the company, or you're paying more. So my Excel sheet will be given out to all the participants for free in this webinar. So please see details below on how to join this webinar and also how to pay to attend the webinar. Thank you so much, and do enjoy the rest of your day.